Okay, welcome back everyone. This video is the second part of a discussion that we started last time, which is about the all-important topic, money and funding your company. So quick recap about what we already talked about in this video. Our framework for thinking about money matters basically has three important steps. The first step is understanding when in your entrepreneurial journey should you actually start seriously thinking about funding your company. The second step is then to analyze your current financial status. How much money do you need on a monthly, quarterly, or annual basis? If you haven't watched the first part, now would be a good time to do that. You can do so by clicking on the link here or in the description box below. There's also a companion video where Gautam explains how to make a simple financial projection spreadsheet to assess your current financial status. Also, now is an excellent time to hit the subscribe button if you like our content and would like to continue to support us. Coming back to the content of this video, now you know when to think of funding and how to analyze your current financial status, which leads us to step number 3. And that is to develop an understanding of all the means of funding available to you. So this video is specifically to dive deeper into step number 3. What are the main means of funding available to you? What are the eligibility criteria for each? What are the pros and cons of each? And are there any strings attached? So let's jump right in. Gautam, what are the main types of funding available to an edupreneur?
Okay, you know what? Let me start screen sharing and show you all the options first. Give me a moment.
Perfect.
Okay. So now there are many ways to get your education business funded, right? In this video, we'll cover 7 of them. We're broadly dividing them into 2 categories. Methods that involve you giving up equity in your company and methods that don't involve you giving up equity, right? Simply put, that's the broad classification we're going for. If you think your venture can grow fairly large and has a lot of potential for growth and scale, you should consider giving up equity in exchange of money to cover your costs in those early days, because that will involve a lot of investment, a lot of fast-paced hiring and firing, all that. Angel funding, venture capital, crowdfunding, enrolling into an accelerator, an incubator are options you can explore. If you're confident of generating a lot of revenue and you feel that that can cover your costs, which means you don't have to give up equity, loans are a terrific option. If you're at that stage where you're exploring, testing, validating, grants and bootstrapping are the way to go. So yeah, that was a quick overview of all the options available for funding. Back to you, Aruna.
Awesome. So there are plenty of videos and resources that dive deep into each funding mode, and we should also link some as part of the video description. What we want to do in this video is to give you a comparative analysis of these various options across the following parameters. So we have 4 parameters. The first is network. Do you already need a network or connections for you to realistically land a particular type of funding? Second, preparation. What kind and level of preparation do you need to land each type of funding? Third, accountability. What level and type of accountability will you have to comply with for each mode of funding once you land it? And finally, control. Will there be a drop in how much control you have over your company? Are you indirectly signing up for being bossed over by someone else if you choose to take that funding loan? So these are some questions we'll answer. And I invite Gautam to start with maybe telling us roughly what are the eligibility criteria, so to speak, for each kind of funding?
Okay, so our next graph captures it into the categories that you mentioned. I've never seen it put across in these parameters, but I would like to start off by addressing the question of eligibility criteria for each across the 4 parameters that you mentioned. Now, in this graph, the 2 important factors we have considered are preparation and network. Like as a one-line summary, I can say that roughly the more reputed, the more high net worth, and the more influential the investors is, the more prepared you should be to earn their time, trust, and their money. Pretty straightforward stuff. But let's break down the axis of this graph, right? What do we mean by preparation? See, when we talk of preparation, we refer back to the 4 stages that your company is likely to go through. And for example, how much work have you done in refining a product market fit, as well as executing on those ideas that you had? In other words, what stage is your company in? Is it in the exploration stage, the validation stage, traction, or scaling? Preparation also refers to how much work needs to be done in order to conduct the act of fundraising. It involves setting up meetings, phone calls, right? You'll have to prepare decks, prepare your financials of expenditures in the past, of revenues in the past, negotiating terms, and learning about fundraising itself. And what do we mean in Access? What do we mean by network? By network, what we're referring to is the strength of relationships you have to the relevant individuals in the investor or startup ecosystem. It's basically your social capital.
Awesome. So now that you've prepared the graph, so to speak, for us, I'll jump into individual data points. And I'm going to start from the corners, right? So let's start from the bottom left. That little blue bubble, that's bootstrapping. So bootstrapping essentially is one where you're not looking for any external funding. You're just using the resources you already have and somehow managing to run your business. And so clearly that requires low prep and low network because you're not looking for external funding. But of course, all you need is revenue and profits if you want to sustain a business, right? Moving on straight up to loans. So loans, on the other hand, need a lot of preparation. Why is that? Because you need a good financial history and you also need to have a good case to present to the bank or a funding agency to be able to secure that loan. But you don't really necessarily need like an inside network into some sort of clique to obtain this kind of thing. So next we move to the top right of the graph, the big bubble called venture capital. Okay, so this is one that requires both the highest preparation as well as the highest network and connections. And why is that? Because Gautam said, here you're trying to grab the attention, trust, and money of some of the most influential, reputed, and highest net worth people on the planet, right? So they're not going to give you their time of day unless you represent a company that has already seen some kind of traction and wants to scale.
Rightly said, Aruna. So, great observations. And if you come down to the middle right now, right, if you talk about angel investment, see, an angel investor investing in you more than your idea per se. They're looking at the team, they're looking at how capable you are, making a emotional judgment and an analytical judgment and deciding they want to invest or not. So they're not necessarily looking for a traction or validation at this point. This point is well illustrated by the well-known fact that several of the most successful companies were funded by friends and family of the founders in the beginning. Whether it be Jeff Bezos' parents loaning him money for starting off Amazon or Google starting in someone's garage, right? Those can count as investments. Now, if you look at crowdfunding, moving on from angel funding, you look at crowdfunding, it's a great way to take your idea to the world for validation. Now, it obviously needs some level of preparation in terms of refining the idea, refining the offering, because you're talking to a strange audience. You're not getting one-on-one time with them. They're evaluating you based on the collaterals and marketing collaterals that you put up. It also requires you to clearly think about what you're going to give investors in return for that money. In some cases, you are in case of platforms like Republic, etc., you're expected to offer equity. In case of Kickstarter, etc., you can actually come up with custom rewards. Now, that's crowdfunding for you. Now, grants. Grants are a great way of covering your expenses when you're experimenting with a particular idea. The best thing about grants is that if you put in some prep and make a good application with detailed milestones to be hit, you stand a good chance of landing one. You don't need to have a lot of connections or social capital for you to be issued a grant. But it does require a good amount of research to find the relevant grants to your field. There may be government grants, philanthropic grants, private grants, up to you to figure out what is available in your geography. Finally, accelerators and incubators, right? They're an excellent way to shortcut your way into an ecosystem of venture capitalists, investors, experts, and a lot of fellow edupreneurs. It's like everybody gathering together in one place. Irrespective of the outcome, you'll walk away with a lot of knowledge, relationships, and connections. If you're a first-time edupreneur, I would highly recommend putting in the effort, file a solid application, and take this route. Simply because you will walk away with a lot of connections, a lot of good feedback from fellow edupreneurs, etc. So first-timer, highly recommend this.
Awesome. So now let's shift gears a little bit. So let's go from the eligibility criteria to examining what are the pros and cons of each method of funding. Because you better know that before you decide what kind of funding you want to go after. And once again, we're going to use a graphic here. This one's titled Effects. And the two axes are accountability and control. So accountability refers to how accountable you will be held by your funders for your actions and decisions. And control refers to how much strategic, tactical, as well as financial control you need to give up in order to secure that funding. And one more thing to point out in these graphs is that the size of the bubble, right, of each type of funding indicates the relative amount of capital each mode of funding is likely to bring in. So clearly VCs will get you the largest amount of money, whereas bootstrapping is zero. And, the rest is self-explanatory. So once again, we start from the corners, and I start with bootstrapping, this time on the bottom right. So it's obvious that you retain all control of your company. That's because you're not really seeking any external sort of funding. And there's no one telling you what milestones need to be hit or how you go about executing on your vision. And you retain complete ownership. But obviously, you also miss out on the network or mentorship or actual capital that you would get from some of the other methods. Moving now on to loans. So with loans, what you get is access to capital. So that way you get more leeway to execute on some of your ideas. If you want to hire extra hands or run those extra experiments, you have capital to work with. On the other hand, the banks will ensure that you're accountable to them to repay. Right? They're going to be after you. So there will be some amount of pressure to get some positive cash flow going in order to make the repayments. But again, you don't really get network or advice and things like that, but you do get capital. Now coming to the other corner, that's venture capital. So compared to all the methods of funding, this is where you're likely to land the highest amount of capital, as well as network and mentorship from VCs. So obviously, you're expected not only to give up a share of equity in your company, but you're also expected to meet some pretty intense demands. Often, these will require you to show high growth in revenues and customer acquisition. Essentially, venture capitalists are looking for high returns from businesses that will address very large markets.
Awesome. Okay, let's go to, since Aruna's dealt to the ones in the extreme, let's go to the ones in the middle, the ones that kind of go easy on both. Okay, let's talk about grants, right? See, grants may hold you accountable to the milestones you said you will meet by a certain date. But rare are the circumstances where they'll penalize you for not following that path, right? Because it by the nature of grants, they give you some leeway. Now, let's talk about angel investors and investors you land via crowdfunding. They may not bother you over how you should build your company or what direction you take, etc. They may not bother much about that. But if you end up in a not so good situation, or if you just screw what you said, do not do a good job with respect to spending that money well, or are careless about it, you will definitely suffer reputation loss, right? For example, if your Kickstarter project fails, right, and Kickstarter has already made it very clear that the proceeds will not be refunded to the donors, but that doesn't mean that you will suffer a little bit of a reputation loss, and that happens very publicly. Like there are instances where I've heard of Kickstarter founders raising money on Kickstarter and actually going about living a lavish life, and then that negative PR hitting them forever, right? It'll always be on record. So that's the difficulty you will face with respect to crowdfunding. Now, accelerator incubators run high programs, right? They demand a greater degree of accountability from you. See, there'll be a soft expectation to meet a certain cadence of timeline-based milestones, because they'll be like, by the end of it, you must at least get to this level of validation or have conducted this many user interviews, right? Now, these are good in a sense that this will also give you some structure, which will help you get most out of the benefits out of the program. So yeah, that's basically accelerators and incubators.
Cool. So that summarizes all types of funding, both the eligibility criteria as well as effects. So what we have not discussed in this video is how to go about getting each type of. For that, as we said prior, we will be linking to resources in the description of the video. So please do check them out. Furthermore, if you'd like us to make a video about that or about anything, if you have questions, do let us know in the comments. All right. Until then, see you next time. Bye.
See you. Bye.